Hooty hoo, all my stock market gamblers. Welcome today. It's MLK Day. Happy MLK Day to everybody. I'm so sad because the stock market's not open. I love when the market's open. I love the markets to be open. Sometimes I wish they were open every day, but I understand we need to take a break. So I hope everybody's out there enjoying the day. Now, what I want to talk today about is a little bit about the markets. Now, the markets are kind of in a trading range. They come down big, up big, down big. They're kind of in this trading pattern. We haven't really moved much in the last 2 months. Now, I do think that we're going to be headed lower. Why do I think this? Well, I think because you get this insider trading going on right now. Not insider trading, excuse me. These are insider sellers. Okay, these are like owners, like the CEOs, like Jeff Bezos is selling a lot of his Amazon stock, Zuckerberg's selling a lot of his Facebook stock, and Elon, of course, is selling a lot of Tesla stocks. Now, these captains are not going to go down with the ship. They see the stock market prices are very elevated, and they're selling to get out. Now, they're getting out. Maybe they're getting out and taking profits. Why? The market's high. And I do think the market's going to come in. Now, is it ready to crash? Once again, I do not think the crash is ready yet. I think we're going to have a pullback, maybe down to the 200-day moving average on the S&P, 200-day moving average on the NASDAQ. But I do think we'll bounce higher from there. I think who knows, we might even hit new all-time record highs eventually later in the year. But I do think we're going to get that 15-20% pullback that I've been talking about. All right, so what I want to talk today a little bit about is the American dream. The American dream of retirement and how this is just not going to happen for so many people. Now, if you're a millennial, you think, I don't need to worry about my retirement. You should be the most worried. Well, here's why. Okay, so we're running that 7% inflation. That's what the government says. I say it's closer to 15%. But typically, I have a lot of friends retiring now. Now, most of them have a house that maybe it's paid off, and maybe they have $1 million to live on for the rest of their life. All right, well, how long will that $1 million last? Well, with 7% inflation, that $1 million purchasing power will be cut down to $500,000 just in a 10-year time period. Now, at 15%, it'll be cut down in about 4 years to 50%. So $1 million really isn't enough anymore. And if you're a millennial trying to save to get to the $1 million for retirement, the more you save, the harder it is, because in 10 years, you're going to need to save $2 million. In 4 years, 40 years when you get to be retirement age, you're going to need to save about $8 million. And that's really hard to do. Okay, so the inflation rate is destroying retirement. But what's also destroying retirement and destroying for a lot of old elderly people that are already retired? Well, it's the rate that you get on your bank statements. Okay, when my parents, when they retired, they would get a 10%, well, it's called bonds, 10%. 10% was common on bonds. 8 to 10% was very common. Now, what does a bond pay you? 1.5%, maybe 2% if you go far enough out. You can't retire with $1 million. Look, you got $1 million, put it into bonds, and you get 1.5%, $15,000. Can you live on $15,000 a year? I don't think you can. You can't retire with that. So what is that forcing people to do? Well, it's forcing the retirees to put their money into risky assets, to put them into the stock market, maybe buy a little Shiba Inu. Who knows what they're investing, but it's forcing them to take a gamble, to take a shot. And now this may work out for a while. Maybe the stock market goes up for another year. But, okay, so eventually what happens, though? Let's say you got that $1 million and you got half of it in the bank or in bonds, let's call that 1.5%, and you got the other 500,000 in the market. Well, what happens when the market crashes? Now, people say the market's not going to crash. I say 50% is very realistic. Look, if we come down 50% from where we are now, we won't even be at the 2020 low. That was just 2 years ago. We're in 2022 now. 2020, the market was 50% lower than it is right now at the bottom. Actually, it is about 55% lower. So 50% crash in the stock market's going to happen over the next 10 years. I guarantee that. Of course, it's going to pull back. And it's probably going to be worse than that. Could be 80%. So if you're retired, you got this $1 million, right? You worked hard. You worked all your life. You saved, you invested, you did all the right things, and you got the $1 million now. But now your income's not coming in. You're retired. And I have a lot of friends in this situation. Look at, they get into their 60s and they start to retire. Very common. And most of them, they got $1 million. Okay, will this last them the rest of their life? Well, they do get Social Security, but that Social Security, it's not going up at the 7% inflation rate. It's not going to keep up with inflation. Pretty soon that's going to be dwindling away and not buying you hardly anything. You can't live off Social Security. So they got to take that $1 million and they got to invest it somewhere. Well, they put it into the stock market, and that $1 million could easily turn into $200,000. Well, then they got to go back to work, but then they're 70 years old. It's hard to get hired for a job at 70 years old. But I want to talk about the banks for a little bit. Okay, so I went into the bank the other day. It was I'll tell you, it was Chase. Okay, I went into Chase Bank, and there were no tellers. No tellers. I go, where's the tellers? Oh, we don't do that at this branch. What do you mean you don't do that at this branch? This branch is just for banking. I don't even know what that means. Just for banking. Okay. Well, anyways, they sit you down at a desk and they ask what you want to do with your banking. Well, they want to make loans. Okay. So they're in the business of making loans. Now, in the old days, and this doesn't go back that far, maybe let's go back 10 years. All right. In the old days, they used to have reserves. Okay. So they had, let's say, $10,000 on deposit, they could make a loan for $100,000. But they were required to have $10,000 in reserve, just in case people come in and they want their money back. They had to have some reserves to give them the money back. Well, today we have no reserve banking. In other words, they do not have your money. And they also are not fighting to get your money. Okay, they don't have your money. They don't care about your money. They don't care if they get your money. In the old days, they used to compete, and each bank, the higher interest they would pay on the savings, the more people would come in and put money into their banks. So people were, let's say one bank was paying 6% on a passbook savings, and the other would say, hey, we're paying 7% to try to draw the money into their bank so that they could make more loans. Now, back then, okay, 7%, and they were loaning this money out. Well, credit cards at 18%. Real estate maybe at 10 or 12%, but then they'd make the difference on the spread. They had the 7% and the spread, but they could loan 10 times more than that 10%. Okay, so they had 10% in reserves, but they could loan out 10 times however much they had on deposit there. So if you put the deposit in, they would loan that money out 10x, okay? And that worked for all right for a while, but they have this thing called the FDIC. Now, the FDIC will insure your money up to $250,000. I think it is now. Okay, so as long as you don't have more than $250,000 in the bank, they promise that they're going to pay you. Well, let's think about this. How much in reserves does the FDIC have? Well, they have less than 1% of the amount on deposit. So that's not even the reserve banking. Okay, they don't have 10% of the money. So if 1% of the people come in and want their money, well, these banks are going to take a tumble. They're going to fall. They don't have your money. Now, I know that's shocking. They don't even want your money because they get the money from the Federal Reserve at 0%, and they can make as many loans as they want, and they can make the difference. Now, okay, let's say interest rates go up. Let's say the Federal Reserve raises interest rates 5 or 6%. Are they going to give you that on your passbook savings? I don't think they are. I think they're going to be at less than 1%. Why? Because they don't need your money. They don't need your money because they do not have fractional reserve banking anymore. Okay, it's no reserve banking. They can make as many loans as they want, and they're going to continue to do this. In other words, the emperor is not wearing any clothes. Look, if someone's going to discover this, that the emperor is not wearing any clothes, they don't have your money. If 1% of the people come in and want their money, they do not have it. They get really weird when you go in and ask for cash. Go in and ask for $5,000 cash. They're going to get very strange with you. They're going to ask you a lot of questions. Probably probably bring over the branch manager to come and talk to you. But look, they don't have your money. The FDIC doesn't have your money. So when you put your money in there, don't be so sure you're going to get it back. That's all I'm saying, okay, right? Because they're just loaning out money, unlimited amounts. Anyways, so they don't have your money. And the FDIC that's insuring it, they have 1% of your money, 1%. Now, granted, you will probably get your money back over time if the banks crash. The FDIC would be guaranteeing it, and the federal government, what would they do? Well, they'd print it. And you'll probably have to wait to get your money back, but they would print your money. And when they give you your money back, okay, so your money will be worth a lot less because they're going to have to print the money for everybody because they just don't have the money. Eventually, this is a terrible system that's going to come crashing down. I don't know when that's going to happen, but it does make me really nervous, right? You put your money in your bank. Don't be so sure you can get it out. That's just my opinion. Okay, when you have no reserve banking, I mean, these banks, there is no leverage. I mean, they're leveraged to infinity and beyond. You can't make this stuff up. Is this a good system? Will this work forever? I don't think so. It makes me worried. I think the banks will eventually have a problem. I think when they have a problem, it's going to be a very big problem that could bring the whole financial system crashing down. And this is not good. And I know this is probably not what you want to talk about on MLK Day, but the markets are closed, so this is all I got to talk about. Markets are going to be back open tomorrow. Now, I think we're going to get a little bit of run up in the NASDAQ. We're going to get up to that 50-day moving average, which is now resistance, and then we'll come down to the 200-day moving average. Now, we haven't touched that 200-day moving average in over 18 months, I think it's been. So anyways, it's going to happen, though. It's going to happen. It's going to happen on NASDAQ and the S&P. If you like this stuff, give me the thumbs up. Just a little rant for you to listen to on MLK Day. Hopefully you're out there having fun. I was just sitting at home a little bored because this is normally the stock market time. And I love when the stock market's open, but it's not open today, but it'll be back open tomorrow. Give me that thumbs up and we'll talk again later in the week. Bye-bye now.